Inflation, Feds raise rates, and a recession is coming. It's been an ugly, crazy week, but we got to talk about it. This is the weekly report on Major Money Matters. Welcome to Major Money Matters. If this is your first time joining us, my name is Major. I'm the host of Major Money Matters, where we talk about mortgages, money, and more. And this is the weekly report. Now, before we move forward, I want to remind you to like and subscribe, hit the bell notification so you get notified weekly when we put new videos out to wrap up the week and tell you about the economy and what's going on in the mortgage space. We also put out videos weekly to talk about the mortgage industry, specifically focus on the VA home loan benefit. So let's get to it, guys. Let's start off with the chart. So let's put it up and talk about this thing and how it's going. Now, those of you who have seen this before know that this chart illustrates mortgage-backed securities. Shout out to Barry Habib, who puts this out on a daily basis and tracks the sale of mortgage-backed securities on the market. As this line trends down, then mortgage rates go up. As this line trends up, then mortgage rates go down. Basically, since January, which is illustrated on the far side of the screen, you see a downward trend in a major way. Not just going down, but going down at a very rapid rate. So mortgage-backed securities are selling off lower, which means higher interest rates for consumers. Now, we did end up with a green day today, a green candlestick. So we got green today, which is great. But overall, we're still trending where mortgage rates are higher. Now, I'm not going to bring out specific rates today, but I will tell you, if you're in a conventional loan, you're in the mid 4s. If you're in a VA loan, you're in the very high 3s to 4%. That's what you should expect, depending on your credit score. If you have a very good credit score, that's what you expect. And I'm telling you the very best rate. So if you're 780 or above or something like that. If you're jumbo VA, so I am a mortgage broker. I have access to multiple different banks. And some banks right now are giving very good rates on jumbo VA loans. So if you're jumbo VA, you could see rates in the 3.6, 3.7 range as of today. If you're doing a jumbo loan, probably helps to reach out to me and let me do a quick scenario and see what your rates are looking like today, because you need to be looking around because rates are going up. Some companies are adjusting faster than others to those rising rates. And I have access to about 20 to 30 different companies that I broker loans to. So reach out, send me your information, just get a quote, no obligation. I'll just take the time to give you a quote and give you some good information. Now, back to the charts. We're looking at mortgage-backed securities here. Now, the Feds did raise rates this week. Now, people believe that the Feds raised rates, so that's why interest rates are higher. That is not true. It sounds good. Somebody might tell you, hey, you need to buy a home before the Fed raises rates. The Fed's raising rates is more correlation, not causation, to higher interest rates. Let me explain to you like this. If you are buying bonds, you want to make sure that the bonds that you're buying are going to give you a return to buy goods and services, a good return on your investment. So if inflation is higher, then that means that you require a higher interest rate on the bonds that you're buying. The Fed raises rates to attempt to keep up with inflation or to attempt to decrease the rate at which inflation goes. The Fed lowers rates to put more money into the economy or to stimulate the economy. And this is a cycle that keeps going on. It is very difficult to get a grasp of. And at this point in time, the Fed has totally lost the bubble. While we were in COVID, they kept rates too low for too long. Now we're in a situation where they're having to increase the Fed funds rate, and they're saying they're going to increase the Fed funds rate 7 times in 2022. The challenge is they're doing too little, too slowly, okay, and they're doing it too late. So inflation is running rampant. Inflation report came out this week. Inflation is up 10%. Okay, 10% inflation year over year. That means that on average, goods and services are 10% higher as a nation, 10% higher than they were this time last year. So that's a very, very big concern. So the Fed is actually increasing rates, but the reason you're paying a higher interest rate is not because the Fed is increasing rates. It is because of inflation and investors requiring more of a return on their investment, especially when you're talking about a 15-year or a 30-year mortgage. So that's what we're seeing right now. Rates are going to continue to rise. This is not going to slow down, and this is not going to go down. And I'll tell you my recommendation if you're in the housing market right now. I'll tell you what I recommend for you. But another problem that we're seeing right now is we don't have enough inventory. Okay, one of my clients won a contract yesterday. 23 offers on that home. Okay. Another one of my realtor partners in Dallas, Texas, sent me a video, and it was a video of a line outside of a home that is priced at $1.7 million, and people are lined up down the sidewalk to view that home. Okay. We do not have enough inventory. Now, we did get an inventory report today that indicates that more inventory is coming, but there are some challenges here. So we see permits here. Permits are down about 2% month over month. Year over year, they are up about 7.7%. So we're getting a lot of permit starts. We're doing a lot of housing starts. Starts are at 6.8% month over month, 22% year over year. So we're starting 22% more. We're starting to build 22% more homes than we were doing last time this year, and that's great. The challenge is the completions. Completions are down year over year 2.8%. All right, so you see the gap there between the number of starts and the number of completions. The challenge is builders are having real supply chain issues. Okay, I have a client that's building a family building a home in Texas. They were talking about there was a shortage of paint. There's a shortage of workers. They're starting a lot of homes, but they only have a select number of teams to work on those homes. Therefore, builders are sometimes getting behind. If you're building a new build right now, the chances of you finishing that new build on time is extremely low. Okay, very few of my new builds actually finish on time. So be aware of that. Just know that situation. We have to navigate that situation with your lock. Okay, you should be aware of how long your lock is, how much it's going to cost you to extend your lock. You know, maybe you want to lock for a longer term. Even if they're telling you 45 days until you close, maybe you want to lock for 90 days and have a lender that locks you for a longer term. You do want to lock your loan as soon as possible right now. As soon as you get your docs in, you do want to lock your loan as soon as possible, because overall, now you might get one day where pricing is a little bit better, like today is better than yesterday where pricing is a little bit better. But overall, you're going to continue to see rates get worse and worse. Now, I also told you that there are recession indicators: foreign war, higher fuel prices, higher prices that you're paying for goods and services. And actually, it's counterintuitive, but low unemployment is actually a recession indicator. Here's the reason why. When the Fed raises rates, it does affect the rate that companies and corporations borrow money in order to commence new projects. Now, those companies are still going to borrow money and commence new projects. They're going to keep building. They want to keep expanding their business. Where do they cut? The answer is they cut employees. They cut employees, and as people get fears of being laid off, or they are laid off, that's when they spend less money. That's less money going into the economy, and that leads to a recession when people are not putting money into the economy. The other situation that we have right now is the government has given a lot of stimulus, and frankly, that stimulus has run out. So people don't have the funds to spend like they had before when they were spending their stimulus money into the economy to generate growth in the economy. So we have what's called stagflation, stagnant wages and inflation at the same time. So now we're in a situation where we're leading directly into a recession. Now, this could happen in the next 6 months, could happen in the next year, but the recession is definitely coming. Okay, we have also market indicators with the yield curve where the inflation is coming. Now, what is that going to mean? Now, people might say, hey, Major, if there's a recession, that means that housing prices are going to go down. That is inaccurate. Okay, I'm gonna throw up this chart here. You can see in the dark areas, those are recessionary periods dating back to 1960. You can see in those dark periods, the housing index, which is the white line, still continued to go higher. The only time that the housing index did not go higher, a housing price index did not go higher, is in 2008, when the housing market was the cause for the recession. So people have recency bias and they're thinking, oh, if there's a recession, the housing market's going to go down. But the challenge is that all the other times that there was a recession, the housing market did not go down. We have another factor playing into this with supply and demand issues. So there is still a lot of demand for homes, even with increasing interest rates. Now we are seeing some buyers back out at the higher interest rates, because with higher interest rates, your monthly payment's higher. So if you're buying a house at the $1.5, $2 million level, you may think twice about that, more than you did maybe 6 months ago when interest rates were in the twos. But you are still seeing a lot of demand for homes. Okay, so this is going to continue because we have more people who want to buy a home than there are homes available. And I already told you that builders cannot build fast enough to meet the demand. People are asked this question of, what's going to happen when these builders build all these homes? That's going to mean that more houses are going to be available. No, because most of these homes that's being built are already under contract. When they break ground, they are already under contract and they're already allocated for. Somebody already is under contract on that home. The builder's not building a bunch of homes and don't have people to put in those homes because people are putting in offers. In fact, you have builders who are going under contract with buyers, and then they're raising the prices prior to closing because of the pricing increase of labor and lumber and the supply shortages. And then you have some places where people are backing out and people are even putting in offers at a higher number with those builders. My advice to you is very simple. Get into a property, okay, when the recession comes, whenever that is. If you have the opportunity to refinance that property, then you refinance and lower your rate. We know that in a recession, interest rates go down. So in a recession, interest rates go down, but housing prices continue to rise. And I've heard some economists say that in a year and a half or so, we could have the lowest interest rates that our country has ever seen because of the recession that is coming. That is impressive, but if you're still looking for a house at that time, you're going to be competing with all the second surge of people who are now competing because interest rates are now low again. So take your interest rate for what it is. Some people believe that, hey, these interest rates are high. That's not true either, okay? Let me throw up this chart. I'll throw up this chart and it'll show you that historically, these interest rates are not high. They're just higher than they were 2 years ago, but these are still historically low interest rates. It's not like in the 80s when interest rates were 18+%. These interest rates are still historically low. We just have to get out of the mindset of my interest rate should be in 2% or something like that, okay? Can you afford the payment? If you can afford the payment, get into the property. Even if it's not your perfect property, your equity is going to continue to grow because of supply and demand pushing prices higher. Your equity is going to continue to grow. And then you can sell that property if you want to and move up. But my advice is very simple. Get into a property because this is not slowing down for probably the next 4 to 5 years. That's it for this week. A little bit long. My apologies. Have a good one. See you next time on Major Money Matters.